You're watching Silver News Daily. Subscribe for more.
There's young folks now, studying monetary history. Why do we have inflation? Where is it coming from? What is sound money? Those discussions and arguments between those two camps, I think it's ridiculous, because the enemy of gold, it isn't Bitcoin, and it's also not equities from my point of view. It's rather bonds, and this is where the potential, actually the buying potential, will come from the bond market, where there's massive turmoil at the moment. Just have a look at yields spiking in not only in the US and in Europe, but especially in Japan.
The financial world is quietly shifting beneath our feet, and silver is about to blow the lid off everything. While headlines scream about gold hitting record highs, a far bigger story is unfolding just beneath the surface. Central banks are sprinting away from the US dollar, loading up on gold like it's going extinct. But here's what no one's telling you. Silver is the real ticking time bomb. We're talking about a metal that hasn't even scratched the surface of its potential. While gold makes the front pages, silver is building pressure in silence. Undervalued, overlooked, and massively underowned. The last time silver was this suppressed, it shot up nearly 400% in less than 3 years. But this time, the setup is even more explosive. With central banks dismantling the old monetary order and investors fleeing fiat chaos, silver could be the dark horse that shocks the world. So what's really driving this hidden supercycle? And how far could silver go when the dam finally breaks? Stick around, because what you're about to hear could change everything you thought you knew about the markets.
I think that gold always has been a monetary asset, and we kind of forgot about that in the Western world. Having a look at this chart, it just shows that 3 years in a row, central banks bought more than 1,000 tons of gold. It's obviously mainly being driven by emerging markets, and I think, Andy, that's something very, very important that we described in last year's In Gold We Trust report, called the New Gold Playbook. We said that the center of the gold world isn't in New York and in London or in Zurich anymore. It's rather in Shanghai, in Dubai, it's in Mumbai. So the majority of fiscal demand is clearly coming from emerging markets, where there's a much stronger affinity for gold compared to the Western world. And now we in the Western world kind of wake up and say, okay, well, there's some momentum in gold. Perhaps we should kind of reconsider that. But I think this chart, it's fascinating that central banks bought more than 1,000 tons in a row last year in absolute terms, and that was more than 100 billion US dollar. That sounds like a lot, but then on the other hand, QE3, what was it, like 60 billion per month? So if you put it in perspective, I think it's still kind of a low number. Last year, Poland was actually the largest buyer. So it's not only let's say Asian central banks. It's also some European countries like Poland and Hungary are buying gold. So from my point of view, those numbers, which is roughly a third of annual gold production. So if you put it relative to annual gold production, that's quite staggering from my point of view.
Yeah, I'd like to pull on that string a little bit in a couple different areas. First, these are reported numbers. One must wonder how much is not reported. And I would think by what we saw last year, where Saudi Arabia got caught not declaring what they had purchased by the import-export numbers, China got caught. China going around, according to many of the miners I talked to, buying doré and concentrate all around South America, which would disintermediate the market and the reporting, and buying things by proxy through commercial banks or whatnot. But this still tells a story. The two strings I would like to pull first is, you mentioned something that I've been talking about a lot lately, and I think is very important, that the real
central banks aren't just buying gold, they're making a statement, and it's one the world can't afford to ignore. In 2022, they bought more gold than in any year since 1950. In 2023, they doubled down. And now, in 2024 and 2025, the trend hasn't slowed, it's accelerated. These aren't small, symbolic purchases. We're talking about hundreds of tons being quietly hoarded, and more importantly, repatriated. Nations like Germany, Hungary, Turkey, and Poland have demanded their gold back from overseas vaults. Why? Because the global financial elite see what's coming: the slow, chaotic collapse of dollar dominance. These banks aren't making emotional bets. They're rebalancing out of fiat currencies and into hard assets that can't be printed into oblivion. But here's the kicker. Every time central banks make these moves, the public only focuses on gold. Yet silver, the monetary metal with even more scarcity and explosive upside, remains in the shadows. This strategic oversight by the mainstream is setting the stage for the greatest catch-up trade in recent history. The smart money has already made their move into gold. The savvier money? They're already eyeing silver. And when the broader market catches on, the revaluation could be breathtaking.
Demand is now, and maybe the control of the market has moved to Shanghai and to the east and to a more of a cash and carry market. The first question I would ask you on this is, do you think that they are using the Western paper suppression against the West? In other words, slowly accumulating gold, using these suppressed paper prices on COMEX, the LBMA, to their advantage? Because it just would seem that they're playing the long game and using the stupidity of trying to hold down the paper price as a subsidy to accumulate the physical. What stock do you put in something like that?
Well, I think we have to differentiate between central bank gold demand and then private demand from emerging markets. I think, if I was in Dubai last year, I was in Saudi Arabia this year at the Future Minerals Forum, which is now one of the largest conference, even though they started it only 4 years ago. And it's, if you talk to people from the Arabic world, from China, from India, from Turkey, for them, buying gold is something very natural. Why? Because they're quite used to, higher inflation, to kind of rubbish currencies, to financial repression. And there's not too many alternatives to gold and perhaps real estate. So they're not living in this over-financialized world like we do in the West. So for them, buying gold is just natural. When it comes to central banks, yes, I agree. They are buying, especially the Chinese, they're owning significantly more than officially announced. Do they use the suppression? Yeah, perhaps. But then I think, they just want to catch up to the amount of, let's say, central bank backing that we in the Western world have. So it's also a sign, kind of a sign of confidence, and I think, just being more respected in the big global game. And I think if you want to play poker with the big guys, you have to bring some golden chips, and this is what they realize actually. But I think it's very important what you said before, Andy. It's not...
The dollar's credibility is unraveling, and confidence in U.S. treasuries, once the bedrock of global finance, is evaporating. For decades, the world relied on the dollar as the ultimate reserve currency, a pillar of trust in an increasingly unstable global economy. But in the past few years, that trust has been shattered. Runaway deficits, unchecked money printing, and politicized monetary policy have turned the U.S. dollar into a high-risk asset. Major economies, China, Russia, India, Brazil, aren't waiting around. They're slashing their dollar reserves, dumping U.S. bonds, and setting up trade agreements in local currencies. Even traditional allies are beginning to question Washington's grip on global finance. What we're witnessing is not just a correction, it's a historic decoupling. The world is moving away from dollar hegemony and toward a multipolar system built on hard assets, bilateral trade, and real value. And as the dollar bleeds credibility, investors are being forced to rethink where they store their wealth. Gold has responded, shooting past $3,000. But silver? It's still early in the curve, undervalued, underappreciated, and perfectly positioned to absorb the tidal wave of capital fleeing fiat failure. The death of dollar supremacy isn't coming. It's already underway, and silver is quietly being primed to thrive in the aftermath.
Only the central bank buy. It's also this trend of repatriation of gold, which is very, very important. And we've got a big chapter on that topic, because it also shows that gold is becoming more important for politicians again. And they're increasingly realizing that, storing that gold within the own borders is something that's really, really important. So to answer your first question, I think that the implications for the monetary order, first of all, it was a consequence of the weaponization of the US dollar starting in 2022 against Russia. That's obvious. And I think the second thing that we will also discuss probably later on is this Mar-a-Lago Accord that has really become mainstream. And, if Scott Bessent, for example, says that, he's expecting some sort of a new Bretton Woods agreement, and that he wants to be part of that administration where something like that is happening. And when he also says that they called him a gold bug and that gold is his largest position by far, I think that's no coincidence. So the big picture is gold is really becoming quiet. There's some quiet remonetization of gold happening. I think we're coming, like if you're at the music festival, there's like
As the West grapples with debt spirals and currency decay, the East is executing a calculated power play, and silver may be its secret weapon. BRICS nations are no longer just talking about de-dollarization, they're building the infrastructure to make it irreversible. Russia and China have turbocharged their gold purchases, but behind the scenes, there's a much broader strategy unfolding. These nations are preparing for a new settlement regime, one based not on paper promises, but on tangible value. Bilateral trade deals are bypassing the dollar entirely. Cross-border payments in yuan, rupees, and gold are gaining traction, and digital currencies backed by reserves, real ones, not debt, are quietly replacing SWIFT dominance. In this emerging monetary order, commodities are king, and silver, with its dual role as both a monetary asset and an industrial cornerstone, is uniquely poised to benefit. While Western investors argue over Fed rate hikes and CPI prints, Eastern economies are hoarding real assets and rewiring global trade. The West is drowning in leverage, the East is moving toward collateral. The deeper this shift goes, the clearer it becomes. Silver won't just follow gold's lead, it will be pulled into the vortex of this new system as a strategic asset. And when that moment arrives, the repricing will be swift, severe, and unstoppable.
Enjoy watching your videos on Kiko, for example, your deep dives into what's going on in the monetary world with Jeremy.
Appreciate that.
No, life is good. I mean, I feel really relieved after delivering my 19th baby now. My wife hates that analogy, but putting out 450 pages of research and analysis in German, in English, also in a compact version in Spanish, starting for the first time in Japanese this year. It's lots of work. It's sleepless nights, waking up at 4 a.m, where you think, okay, well, actually, page 322, is that perhaps wrong? But then when the report is out, with delivering a baby, you're super happy, you're relieved, everybody congratulates, and everybody's happy because, there's...
Silver isn't just riding gold's coattails, it has a destiny of its own. While most investors still view silver as a sideshow to the gold story, history tells a different tale. Silver has been money for thousands of years. Empires were built on it, wars were financed with it, and when paper currencies collapse, silver doesn't just follow gold. It often outpaces it in ferocity and speed. But this time around, the setup is even more skewed. Silver is trading at a fraction of its historical highs, even as gold breaks records. The gold-to-silver ratio remains stretched near historic extremes, screaming undervaluation. And unlike gold, silver isn't being gobbled up by central banks yet. That's exactly what makes it the perfect sleeper asset. Retail investors can still access it, industrial buyers still need it, and when the monetary panic spreads beyond gold, silver will be the only other precious metal with the liquidity and utility to absorb the shock. Think about it. If the world truly loses faith in fiat, what happens when gold becomes too scarce or too expensive to buy? The answer is silver, not as a consolation prize, but as the next logical step in a full-scale flight to real assets. Silver's moment won't be a slow burn, it'll be a snapping point. And when it happens, you won't be able to get in at these prices.
And we do have two funds that actually combine gold and Bitcoin, which has caused quite a lot of discussion, especially, not only from the gold community, but also from the Bitcoin community. I'm not an old fart yet, but I'm definitely not very young anymore. So I'm somewhere in the middle. So I really like both, kind of gold for stability, Bitcoin for convexity, and it makes sense to combine both very, very hard monetary assets with a very high stock to flow ratio. But what I really like about that is that in the Bitcoin community, there's young folks now, studying monetary history. Why do we have inflation? Where is it coming from? What is sound money? They discovered the Austrian School of Economics, and I think that's a very, very important discussion. Therefore, I think all those discussions and arguments between those two camps, I think it's ridiculous, because the enemy of gold, it isn't Bitcoin, and it's also not equities from my point of view. It's rather bonds, and this is where the potential, actually the buying potential, will come from the bond market, where there's massive turmoil at the moment. Just have a look at yields spiking in not only in the US and in Europe, but especially in Japan.
There's a supply crisis brewing in the silver market, and it's being dangerously underestimated. For 4 straight years, the silver market has run a structural deficit. Demand has outstripped supply by hundreds of millions of ounces. In 2024 alone, the shortfall was nearly 149 million ounces, with projections for 2025 still deep in the red. That's not a fluke. It's the result of chronic underinvestment in silver mining, declining ore grades, and a dangerous over-reliance on byproduct output from base metal mines. Silver isn't mined like gold. It's usually a secondary product in copper, zinc, or lead operations, which means producers can't simply ramp up silver production when prices rise. The supply curve is rigid, and it's falling behind fast. At the same time, industrial demand is relentless. From solar panels to electric vehicles to next-gen electronics, silver is indispensable and irreplaceable. Recycling can't fill the gap either. Scrap supply has remained flat, even with higher prices. This imbalance has forced the market to eat into above-ground inventories, and those stockpiles are vanishing. Vaults in London and New York have seen significant drawdowns, and the physical market is already showing signs of strain. It's only a matter of time before this tightness translates into price shock. The moment a major buyer tries to secure a large volume of physical silver, the market could snap. Prices could spike, not gradually, but violently, because there simply isn't enough metal to go around. This is not just a bullish factor. It's a fuse, and it's burning fast.
The head of StoneX, I think he said 2,000 tons were moved from London to COMEX, and that kind of confirms what my view is and what my contacts say. So who has actually bought it? Well, actually, I don't know if you follow the work of Michael McNair, for example. He says, from a legal point of view, for the US, it would be no problem at all to actually increase gold reserves. I'm not really sure about that, but perhaps that could actually be, a big surprise. And we all know how Donald Trump enjoyed surprising markets, that actually the US doesn't own less, but actually more gold than officially known. I don't know. From my point of view, it is not the US government buying gold, but rather large institutions. We've seen recently that Ray Dalio, for example, increased his positions. From my point of view, and this is also what my contacts tell me, it's big family offices, it's institutional players. We're seeing, that probably you know that much better, that physical retail demand is doing pretty well, but that doesn't really explain those big numbers. Just one thing that puts it into perspective. We've got one chart in our report. It's based on UBS numbers, and they did a survey of family offices worldwide, and I think people often forget how influential family offices are nowadays. So their allocation to precious metals, so not only gold, but precious metals in general, is 1%. So, we did a study called the optimal gold allocation, which said 14 to 18% really improves the characteristic of a let's say, balanced kind of typical portfolio, 1% doesn't make any difference at all from a portfolio point of view, especially if you own like 43% government debt in that portfolio. So I think this is really
the gold to silver ratio is flashing a once-in-a-generation signal, and almost no one is paying attention. Historically, when this ratio stretches too far, it snaps back with a vengeance, triggering some of the most explosive silver rallies ever recorded. Right now, the ratio is hovering near 100, meaning it takes 100 ounces of silver to equal the price of 1 ounce of gold. That's an extreme divergence. For most of modern history, the average has floated closer to 50.1, and in true bull markets, it can collapse to as low as 30.1, or even 15.1 in extreme cases. What that tells us is simple. Silver is deeply, structurally undervalued relative to gold. We've seen this before. In 1980, when silver exploded to $50, the gold to silver ratio plunged below 20. In 2011, as silver surged again, the ratio fell dramatically. And now, gold is already in liftoff mode and silver is still on the runway, waiting for the engines to ignite. But when that ignition hits, when investors realize how wide the spread has become, the rush into silver won't just be powerful, it'll be panicked. Because every percentage point that ratio contracts represents a huge multiple of upside for silver. This isn't just a technical setup, it's a historical trigger. And once that trigger is pulled, the reversion won't be smooth. It'll be sharp, sudden, and life-changing for those holding silver before the stampede begins.
But what's happening now, gold isn't a contrarian investment anymore. But I think that the mainstream, and it is also kind of what we call this year's report, the big long. We refer obviously to the big short, and I think, you know, if we compare it to the situation where you know, Michael Burry and those kind of very contrarian, kind of shrewd investors that weren't really taken serious by Wall Street, but at some point, I think, you know, Wall Street guys, perhaps not openly, but they kind of realized, okay, something big is going to happen and it's not going to be a good thing. So that must probably have been like end of 2006, beginning of 2007. And I think in the gold world, we're somewhere similar where not the super large institutional players, because they're super bureaucratic and they're, you know, everything takes ages for them to make a decision because everybody has career risk. But I think many market participants are kind of realizing, well, we don't own any gold. That's a risk. There's like talks about Mar-a-Lago. There's like a structural demand drivers that are just continuing to push the price up. And I think they want to enter or they want to start allocations now. And this is also the reasons why we're only seeing very shallow corrections, because there's so much capital waiting on the sidelines at the moment and everybody wants to buy the dip. So that would be kind of my view, that slowly but surely institutional players, family office are starting to get into gold.
As global tension escalates and trust in institutions crumbles, capital is fleeing to safety. But it's not just gold that's benefiting. Silver is riding the same wave of fear, and it's preparing to take that wave to a whole new level. Look around. Trade wars are intensifying, debt ceilings are meaningless, and central banks are cornered by inflation they can't control. In moments like this, investors don't want promises. They want proof. That's why gold has soared past $3,100. But silver, the metal with the same safe haven credentials and even more upside torque, is now catching fire. In Q1 2025, when U.S. tariffs sent shockwaves through global markets, silver spiked to over $34 almost overnight. That wasn't always speculation, it was panic-driven buying. Investors and institutions scrambled for exposure to real assets that could hold their value when everything else was in freefall. And what they found was that gold was crowded, silver wide open, more liquid than platinum, more affordable than gold, and far more volatile when the dam breaks. In a financial storm, silver doesn't just survive, it thrives, precisely because it lags at first. It's the second wave of capital, the stampede after gold. And when it hits, silver doesn't move by dollars, it moves by multiples. The flight to hard assets has already begun. Silver's turn is next.
I'm completely honest. I think, you know, silver has been a big disappointment. let's face it. I think we all expected silver to really start outperforming gold already earlier. I mean, that's a logarithmic chart, obviously. So it shows me that once such a cup and handle pattern is resolved, what does actually the handle mean? That's like a consolidation on the higher level, where basically there's bulls and bears are kind of fighting against each other, and then at the breakout the bulls actually win. And we've seen that with gold, with really this textbook breakout and then rising up to 2,700 within a very short time frame. So one of the core views of this year's In Gold We Trust report, the big long, is that gold already did pretty well. I mean, gold is up 25% year to date in 2025. That's pretty nice, I would say. Gold was up, let's say, 30% in basically every fiat currency last year. Or let's put it from a different point of view. Most fiat currencies devalued a third against gold in just 1 year, which is pretty significant. But silver hasn't really done what it's supposed to do. Now, I think from a fundamental point of view, we're seeing, and you all know that, we're seeing this deficit now, the fifth year in a row. We're seeing that industrial demand is growing at a solid pace. But what we're missing so far is like big investor demand. We haven't seen that yet, but I think it's going to happen, because at some point people will say, well, gold is already kind of too expensive for me. I want to buy the little brother of gold, which is silver. So that's going to happen at some point. So my take has been, and we analyzed that in the report, gold always goes first, and then silver, the mining stocks, and also the commodities follow. So that's kind of my cycle view going forward. I would expect silver to really start outperforming gold now big time, but we really need investor demand. The numbers you mentioned before, I mean, Bateman is buying physical gold, and the gentleman who just retired called Buffett, we all know that he did a pretty good investment on silver back in the days. Yeah, perhaps he did it again. I don't know, but silver, not only relative to gold, with the gold silver ratio at almost 100, but also in absolute terms, I think it's probably the bargain of the century or whatever. Yeah, I think it's just a steal at those price levels.
Silver has finally broken through the ceiling that capped its rallies for over a decade, and what comes next could rewrite the chart books. For years, the $30 mark acted like an invisible barrier, frustrating bulls and confounding traders. But in late 2024, silver blasted through that resistance, touching $34.87 and hitting its highest level in over 12 years. That breakout wasn't just technical, it was psychological. And now, in 2025, silver has turned that former ceiling into a new floor. With prices consolidating in the low 30s and momentum building again, analysts are eyeing $35 as the next critical line in the sand. But this isn't just about price levels. This is about sentiment. Once silver breaks $35 convincingly, it enters a zone with virtually no overhead resistance until $40. And beyond that, the floodgates open toward its all-time highs. Technical indicators are screaming bullish. Over 90% of moving averages are in positive alignment, and volatility is rising in tandem with volume. This is exactly what precedes the kind of parabolic runs that silver is famous for. Unlike gold, which moves with institutional discipline, silver runs on emotion, momentum, and fear of missing out. And right now, the technical setup is creating the perfect storm for another vertical surge. The chart doesn't lie, the price action is speaking. And when silver climbs above $35 with conviction, it won't be asking for permission. It'll be charging forward with fury.
Talk about that for 4 hours. I mean, that's really the structural, the major structural and central problem that we have in this world. The lack of a neutral monetary reserve asset. And the interesting thing is, I think that people in this administration are actually aware of that. You know, Stephen Miron, he wrote a brilliant paper. I commented on that on Twitter. I really read it, I think 4 times, and highlighted so many different points that are crucial to understand. So there's already the playbook is already in place. Now, the big question is, can such a, I think Trump is very open that he wants it, that he needs a weaker dollar. The big question is, can such a controlled devaluation, is it gonna work out? That's really central for me. And we write in the report, it's like asking for warm ice lollies. So it's kind of, you know, it defies economic physics, if you want. So you know, there's many ways, or not many ways, but there's a few ways to actually solve the Triffin dilemma. You need a neutral monetary reserve asset. You can have, for example, to balance those structural deficits, those global imbalances that are driven by our current monetary system, and those twin deficits, SDRs could be used, and you know, the IMF has them in place. And a friend of mine said, what was it, like, money used to be IOU gold. Then it became 1971, I owe you nothing. And then SDRs are who owes you nothing. So I think nobody on this planet really 100% SDRs. So therefore, I'm not really sure if that's going to be the solution. Of course, John Maynard Keynes, during the Bretton Woods conference and afterwards, he talked about the Bancor, for example. This is something that I think many things are pointing into that direction. But gold, I think, fits the purposes the very best. Bitcoin could do it as well, but Bitcoin is not globally really accepted. It's not liquid enough. We don't have enough monetary history when it comes to Bitcoin. So I think there will be ways let's put it that way. The only way to really solve Triffin's dilemma would be introducing a neutral monetary reserve asset, and that can only be gold. Now, is this Mar-a-Lago conference really going to happen? I don't know, because if we look back to, for example, the Plaza Accord and the Louvre Accord, you know, this was a time of global cooperation, and they actually sat together and discussed and came up with the solution.
Silver isn't just a safe haven, it's a critical industrial metal, and that dual identity is becoming its ultimate superpower. While gold sits quietly in vaults, silver is getting consumed at record pace across some of the world's most rapidly growing industries. Solar energy, electric vehicles, 5G infrastructure, medical tech, these are no longer fringe sectors. They are the backbone of the next industrial era, and every one of them depends on silver. The solar sector alone now accounts for nearly 1/5 of global silver demand. And here's the catch. Silver's role isn't optional. It's irreplaceable. No other metal conducts electricity with the same efficiency and reliability under industrial conditions. Governments are mandating green transitions. Corporations are racing to meet net zero targets. Billions are being poured into infrastructure that demands more silver, not less. And all of this is happening against the backdrop of a supply chain that's already stretched to the limit. Every ounce that goes into a solar panel or EV battery is one less ounce available to investors. This is where silver's story diverges from gold. While gold's demand is driven by fear, silver's demand is driven by both fear and function. It's not just a hedge, it's a necessity. And that necessity is growing at a rate the mining industry cannot match. When an asset is both needed and hoarded, scarcity becomes inevitable. And when scarcity meets speculation, prices can go vertical. That's not a theory, it's a pattern. And silver is about to repeat it.
It's pretty much the same. So I think Donald Trump and his team, they understand, the consequences of our monetary system. They understand the importance of the petrodollar, and they need the support actually by the Saudis, and I think also to some degree by the Europeans and even the Chinese. So let's put it that way, Andy, those things like revaluing gold coming back into our monetary system, auditing Fort Knox, those were like, topics that were only discussed in the gold scene, yeah. But now they are becoming, mainstream topics, and this is quite important because it's telling me that gold is really, as I've said before, we're on the main stage now, yeah. So as the famous blogger, another and friend of another, those kind of secretive bloggers, he said, you only need one gold revaluation in your lifetime, and I think it could happen, and then we're not going to talk about 3,200 or 3,500. We're talking completely different numbers.
Wall Street's paper games are starting to fail, and when they do, silver could detonate. For years, institutional players have used derivatives, futures, and unallocated contracts to suppress silver's price, creating the illusion of abundant supply. But that illusion is breaking down. As physical demand grows and inventories shrink, the gap between paper silver and real silver is becoming impossible to ignore. COMEX vaults are being drained, London inventories are thinning, and delivery times are stretching longer. These aren't just minor hiccups, they're the early signs of a breakdown in confidence. The entire paper-silver system is built on one assumption, that most contracts will never demand delivery. But what happens when that assumption fails? When just a fraction of contract holders stand for delivery, the whole structure becomes vulnerable to collapse. We've seen this movie before. In 2021, when retail investors targeted silver for a short squeeze, premiums on physical metal exploded, and dealers couldn't keep up with demand. That was just a tremor. The next quake could come from sovereigns or institutions demanding metal they can hold in hand, not promises on a screen. And when that shift happens, the unwind will be brutal for the shorts. Because unlike gold, silver's volatility and thinner market depth make it far more explosive when pressure builds. The manipulation narrative isn't a conspiracy, it's a reality. But it's a reality that only works as long as trust holds. And right now, that trust is eroding fast. When the day comes that paper silver can't meet physical demand, the repricing won't just be dramatic, it'll be violent. And those still betting against silver, they'll be caught in the firestorm.
I really enjoy about my job is just traveling to all sorts of places. And I did speeches in, 40 countries, whatever. And by far the best questions were asked at a conference in Istanbul, in Turkey, because they know everything about gold. Why do they know everything about gold? Because they're so used to a weak Turkish lira. They are used to high inflation numbers. So for them, actually getting inflation right is like the first step when they discuss asset allocation. Now, we haven't seen any inflation, let's say for the official numbers, over the last couple of decades, this so-called great moderation, after Paul Volcker killed inflation. Inflation numbers were coming down. Obviously, treasury bonds were going up, yields were going down. So there was actually no need to own any gold because inflation was dead and, central banks had everything under control. Now, I think in the Western world with this spike in inflation, I think that was a wake-up call for many investors, but still the majority of institutional investors that I talk to, they say, well, it was just, like Madame Lagarde said, it was a hump, or it was transitory or whatever. And everybody thinks that we're going back to the old regime where inflation is like the least concern for portfolio construction. I don't think so. Inflation numbers are very stubbornly at very elevated levels, even the official numbers. And we could discuss inflation also in detail, but I think that with the debt levels that we're now at, and we've seen with Doge, for example, that it's not that easy actually slashing your budget because there's elections coming up again, and everybody's so used to this fiscal stimulus. So the need for inflation is obviously higher than ever, and therefore this erosion of trust that we're seeing It's not only, it's in the media space. It's when it comes to politics. It's when it comes to celebrities. When it comes to science. It's basically in every in every part of our lives, and also this steady erosion of trust in money and in the future purchasing power of money. And I think that many people are kind of perhaps not they're not openly saying that there's they expecting inflation to go higher or to remain at high levels, but they can kind of feel it.
The U.S. Treasury market, once considered the safest asset class in the world, is now a ticking time bomb. And when it goes off, it could send silver into orbit. For decades, treasuries were the foundation of global portfolios, the go-to for liquidity, safety, and yield. But all of that has changed. Foreign demand is drying up. Key buyers like China and Japan are pulling back. Even domestic institutions are questioning the long-term stability of holding U.S. government debt as fiscal deficits explode and interest costs spiral out of control. This isn't just a bond market correction, it's a confidence crisis. When the full faith and credit of the United States is no longer taken for granted, the ripple effects are enormous. Investors start looking for alternatives that can't be inflated, manipulated, or defaulted on. That's why gold is breaking records. But the smart money knows there's another asset even more primed for a breakout: silver. Why? Because when treasuries falter, the exodus into hard assets doesn't trickle, it floods. And silver, with its affordability, liquidity, and dual role appeal, becomes the next magnet for capital. Every tick higher in treasury yields adds fuel to the fire. Every downgrade, every budget showdown, every hint of political dysfunction makes the case for real assets stronger. And in that environment, silver isn't just a beneficiary, it becomes a necessity. The world is waking up to the fact that debt-backed promises are no substitute for tangible value. And when that realization hits the bond market with full force, silver's slingshot moment could finally arrive.
And that's also the reason why people are spending money like crazy, because they think, okay, if I've got my money in my savings account, it's being inflated anyway, so just spend it, waste it, or gamble in those YOLO stocks or whatever. But I think this is kind of the zeitgeist that we're seeing now. Most people cannot address where this erosion of confidence is really coming from. Most people cannot address, that's why I always say that you actually have to teach monetary history in primary school. That would be super important. But I think that people are kind of waking up, and I mentioned Bitcoin in that regards. And obviously there's the work that you are doing and many other people, where people just watch YouTube videos and then they, go down that rabbit hole and realize or learn about monetary history. And they come to the conclusion that actually, owning some gold and silver perhaps makes sense. So that's kind of this loss of trust that we're seeing. And, the interesting thing about trust is it's very asymmetrical. I'm together with my wife for 20 years now. So we've built this trust capital over 2 decades. But if I come home from work and I see her with, the neighbor or the pool boy or whatever, obviously the trust is gone. It's gone. And you cannot really repair that. You cannot go back. And I think that gold has really built up that trust capital, not over decades, but actually over centuries. While, fiat currencies have a pretty poor history of preserving purchasing power. And I think that's more and more people are really finally waking up to that thought.
Silver's journey to $500 may sound outrageous until you look at the storm that's already begun. Central banks are abandoning fiat, hoarding gold at historic levels, and silently preparing for a monetary reset. The US dollar, once untouchable, is losing global trust as treasury demand collapses and deficits spiral out of control. Meanwhile, the East is rising, reshaping the global monetary order around hard assets. And while the world watches gold take center stage, silver is quietly building momentum, driven by a relentless supply crunch, skyrocketing industrial demand, and a market structure stretched to its limit. The technicals are aligned, the fundamentals are explosive, and the psychology is shifting fast. When silver breaks its next resistance levels, it won't be a slow grind. It'll be a vertical sprint, just like we've seen in every previous monetary panic. But this time, the forces are stronger, the distortions are bigger, and the stakes are higher. Whether it hits $100, $250, or even $500, one thing is becoming clear. Silver is not just a metal, it's a monetary warning siren screaming that the old system is cracking. If you've been waiting for a sign, this is it. The reset is coming. Stay sharp, stay informed, and make sure you're on the right side of history. If you found this eye-opening, hit that subscribe button and join the movement. And remember, this isn't financial advice. Always speak to a professional before making any investment decisions.